My friends, welcome. And here this is Ravi Telugu, and I am here to make you perfect in commerce, accounting, tally, GST, income tax and TDS as well. Here we just designed this course that even a non-commerce student can understand. Now we'll just start from scratch. I just wanted to know what is meant by commerce. What is commerce? Commerce is another word for trade or business and can simply mean a buying and selling of goods and services. In other words, a commerce is just an exchange of benefits. What is commerce? Commerce is just an exchange of benefits. Exchange of benefits is called as commerce. Acha. If I am selling my mobile, if I am selling my old mobile to my friend, and if I am receiving rupees 10,000 my friend, do you treat that as a commerce? No. Commerce is not about exchanging benefit for one time. Commerce is meant by itself. Commerce means exchange of benefits in a large scale, that too in a rotate manner. Then only treat that as commerce. When you are exchanging benefit for one time, that won't be treated as commerce. Now what is commerce? Commerce is what? Exchange of benefits in a large scale, that too in a rotate manner. Then it's called as commerce. An example, a trading between two countries is called as commerce. See, wherever benefits are being exchanged in a large scale, wherever benefits are exchanged in a large scale, there is an auto involvement of resources. Acha. What is mean by resources? Resources means like cash, capital, properties, assets and customers, vendor, purchase, sale, income, expenditure, the things whatever is going to involve in business is called as resources. So wherever goods or services being exchanged in a large scale, there is an auto involvement of resources. Wherever resources are involving, you cannot, as a single person in your mind, you cannot handle all these resources. So wherever resources are involving in a business, there is an auto requirement of accounting. Once I repeat, commerce means what? Commerce means exchange of benefits. Wherever benefits are being exchanged in a large scale, there is an auto involvement of resources. Wherever resources are involving in a business, there is an auto requirement of accounting to handle these resources. Right? So wherever accounting is needed, there is totally two systems. One is a single entry accounting system and the other one is a double entry accounting system. In single entry accounting system, we are going to maintain book of accounts based on one aspect, either receivables or payables. But in double entry system, we are going to maintain book of account based on dual aspect. That means we are going to maintain book of account for receivables as well as payable, for receiving aspect as well as giving aspect. So now just keep it aside. Now we'll just understand with the double entry accounting system. What is a double entry accounting system? Yes, a double entry accounting system is a bookkeeping method. Yes, now we just understand the elements that involved in a double entry accounting system. Yes, a double entry is an accounting system which maintains records for receiving aspect as well as giving aspect, and the receiving aspect called as debit and the giving aspect called as credit. Are you understanding? Double entry is an accounting system maintaining a record based on receiving aspect and giving aspect. Receiving aspect is known as debit and the giving aspect known as credit. Of course, the debit and credit can be named differently when we are discussing about classification of account, likely, personal, real, nominal. So in that time again we'll discuss once again about debit and credit. But now we'll just understand the basic principal elements of the double entry accounting system. And the number one element is that data collection. In double entry accounting system, if you want to maintain book of account, first you need to collect the data. So first element is about that data collection. Of course, in a business, we'll maintain all the business data in the form of sentences or in the form of invoices. So first, if you want to prepare book of accounts, first you need to collect the data. How we collect the data in the business? Of course, the business data is already recorded. The business information is already recorded in the form of invoices or in the form of sentences. For example, cash paid to somebody else recorded in company or some notebook and received a check from somebody else, so we recorded somewhere, or purchasing good from somebody X, so we have some purchase invoice, and selling goods to some Y, so we have invoices. So first we just collect the business information, in the form of sentences or in the form of invoices. So first we need to collect the business information, and the second one is that journals. What is that? Journal. What is journal? See, how we are collecting business information? We are collecting business information in the form of invoices or sentences. As a human being, we know very well how to read it. So simply by reading those invoices or sentences, we can understand what happening in that activities. But now a double entry accounting system is not a human being to come and read invoices or to come and view the invoices. Yes or no? So what we'll do means, the first element is that data collection. After once the data is collected, you need to convert the basic information. You need to convert all the basic information to accounting transaction. Our understanding, first we collected business information in the form of invoices or sentences that can be read by a human being, but that cannot be read by a double entry accounting system, because double entry accounting system is not a human being to come and read. So what we'll do means, we just convert the basic information into accounting transaction. The conversion of regular information into accounting transaction is called as journal, and journal is also called as original entry. So whatever business information you collected in the form of invoices or sentences, we are going to convert into accounting transaction, is called as by writing debits and credit. That's called as journal. What is journal right now? Journal is a process. What is journal? Journal is a process which converts business basic information into accounting transaction. That's called as journals. For example, if you have 1000 invoices, for that 1000 invoices you need to prepare 1000 journals. Are you understanding? If you have 1000 invoices, for these 1000 invoices you need to prepare 1000 journals. So what happened means, in a business, I just wanted to know what is my purchases, or what is my sales, or what is my remaining cash balance. So in these 1000 invoices, for example, per day, if you have 100 invoices, for 3 months you may have 3000 invoices. So out of 3000, how did you calculate what is your purchase? Well, see, will you check each and every transaction on the time of whenever you need the report? Will you each and every time recheck all the function about plus purchase minus? So it is very difficult to get the information about your business by following these journals. So what will means, the second element is the ledger. What is ledger? So in journals, what we did, we just converted all the 1000 invoices into 1000 journals. Out of these 1000 journals, we collect the accounting heads. What we'll do, we just collect the accounting heads, the resource heads. Okay, we'll just open an account in the name of purchase, and out of these 1000 journals, we just keep dropping all the purchase related transactions into a purchase book. Then again we open a sales book, and we'll just keep dragging all the sales transactions into this book. So we just prepare individual books, we just prepare individual statement for respective accounting heads. We just transfer all purchase related transactions from this journal to a separate book, and again we open a sales book, and we just transfer all the sales related out of these journals, or we just convert all the sales related transaction from this book to a sales book. Again we open a cash book, and we just transfer all the cash transaction from journals to cash book. So likely we just open each and every accounting heads, and we just transfer the respective accounts, respective journals from journals to this book, and the process called as ledger posting, and the statement called as ledger statement, and the statement head called as ledger account. Once I repeat, the process of posting entries is called as ledger posting, and the book is called as ledger statement, and the account and the book head called as ledger account. So what we have done, first we just collected all the business information, and whatever business information you just converted from regular information to accounting transaction is called as journals. So for that 1000 invoices, you prepared 1000 journals. Out of these 1000 journals, you just transferred again all purchase to purchase book, all sales to sales book, all petrol expenses to petrol book, all cash transaction to cash book. So you are just maintaining individual accounting heads is called as ledgers. The processing called as ledger posting, the statement called as ledger statement. So if you open purchase book, at down you may find out what is the total purchase. If you open sales book, you may find out at down what is the total closing balance of sales, and if you once open cash, you may find out what is the total cash balance. So this is how we just do. And after that, acha. So in my book of accounts, purchase showing some X balance, sales showing some X balance, and the cash showing some X balance, and the petrol expenses showing some X balances. Acha. In the purchase, it is showing total 10 lakhs. In the sales, it is showing total 30 lakhs. And in the cash, it is showing some X balance. In the petrol expenses book, it is showing some X balance. Is the balances are right or wrong? Yes, is the balances are right or wrong? To whom you approach to know the accuracy of the accounting closing balances, to know the accuracy of ledger closing balances, to whom will you ask? Will you ask your chartered accountant? Will you ask your auditor? No. So you no need to approach any third person. You can check the accuracy of the ledger closing balances yourself only by preparing the third element of journal entry is, the third element of double entry is a preparation of trial balance. First, data collection, journals, ledgers and trial balance. What we'll do in trial balance, that means we just keep the ledger head name and we just keep writing the closing balances. In a ledger, in a purchase ledger, if you are getting a debit closing balance, just keep writing in debit side of the trial balance. In the purchase book, if you are getting a credit closing balance, just keep writing the same balance in credit. So likely you just post all the accounting heads names, all the ledger heads names along with the closing balances in the respective debit side or credit side. In the down to the trial balance, if you are getting all the debits total is equals to credit total, then it is an accurate, then you may confirm that all the book of accounts before whatever you prepared on ledgers and journals are right. And once getting a valid trial balance, you are allowed to prepare a final accounts. Are you understanding once again? Once by getting only a valid trial balance, you are allowed to prepare the fifth element, that is a final accounts. In final accounts involves in again three sub elements. The first statement is that a trading account. What is that? A trading account. Trading account is a statement which shows the business net result. Sorry, trading account. A trading account is a statement which shows business gross result, whether the business is giving you gross profits or gross loss. So you may find out the business gross result by preparing a trading account. Then what next? The next one is that profit and loss account. What is that next one? Profit and loss account. In the profit and loss account is a statement which shows the business net result, whether it is giving you net profits or net losses. And after that we have the next statement, that is a balance sheet. To know the business financial position, to know the business financial position, we are going to prepare a balance sheet. In the balance sheet you may find out your assets and the properties along with the liabilities. And this is the end, this is the last report that which we of course we may involve in schedules that we'll discuss in the coming sessions.